Every single day, governments around the world sink deeper into debt. The United States owes more than $38 trillion. Japan owes over $9 trillion. The nations of Europe together owe tens of trillions more. Even countries overflowing with oil, natural resources, and exports are carrying staggering amounts of debt. At first glance, it looks like the global economy is standing on the edge of a cliff. But here's the question almost nobody stops to ask. If every country is borrowing money, then who on earth is doing the lending? Who actually owns all of this debt? Is it China? Is it Wall Street? A handful of billionaires pulling strings from the shadows? Or is the truth far stranger than any conspiracy? Because once you start following the money, something strange happens. You discover that the world's financial system isn't really built on piles of cash. It's built on something far more fragile: trust. Almost every dollar, euro, pound, and yen moving through the global economy today is tied to debt in some way. Governments borrow. Banks borrow. Businesses borrow. Families borrow. Even the money sitting quietly in your bank account exists because of a system built around lending. That might sound unbelievable right now, but by the end of this video, you'll understand why economists say modern money and modern debt are almost impossible to separate. And you'll discover why the world's biggest economies may never actually plan to pay back what they owe. To understand how we ended up here, we need to rewind more than 300 years. Back before stock markets ruled the headlines. Before credit cards. Before online banking. Long before America became the world's financial superpower. Our story begins in England, in the late 1600s. At the time, England was locked in a brutally expensive war against France. And wars were never won by soldiers alone. They demanded ships, weapons, food, supplies, and above everything else, money. The problem was painfully simple. The English crown was running out of it. Taxes couldn't keep up with the cost of war, and the gold reserves were shrinking by the day. The government needed a new solution, and the one it found would quietly change the world forever. Instead of hunting for treasure or crushing its people with overnight taxes, the crown approached the richest merchants and investors of the kingdom with an unusual offer. Lend us your money today, and we will repay you later, with interest. It sounded risky. But there was one crucial difference. The government wasn't promising to repay from its own personal fortune. It was promising to repay from future tax revenue. As long as England kept existing and its people kept paying taxes, investors could expect their money back. And that small detail made it a revolutionary idea. Not because governments had never borrowed before, but because these promises could now be bought, sold, and traded like goods in a market. A loan was no longer just a loan. It had become an investment. To manage this brand new system, the Bank of England was founded in 1694. That single moment changed financial history forever, because it introduced the invention that still powers the global economy today: government bonds. At first, they were nothing more than promises to repay borrowed money. But over time, they grew into something much bigger. They became trust itself, printed on paper. And once other nations saw how powerful that idea was, everything changed. France copied the model. The Netherlands refined it. The newly born United States used it to finance its own growth after independence. For the first time in history, nations realized they didn't have to wait until they had money to spend it. As long as investors believed in them, they could borrow. And that discovery reshaped the world economy forever. Which brings us to the question you're probably asking right now. Okay, governments borrow money. But who exactly are they borrowing it from? The answer surprises almost everyone. Let's start with the biggest borrower on the planet, the United States. With a national debt above $38 trillion, it's easy to imagine America writing one gigantic check to another country. Maybe China, maybe Japan, maybe a shadowy club of international banks. But that's not what actually happens. In reality, most of America's debt is owned by Americans themselves. Sounds strange? Let's break it down. Whenever the U.S. government needs money, it doesn't walk into a bank and ask for a loan. It issues something called a treasury bond. Think of it as an official government IOU. An investor hands the government money today. In return, the government promises to pay interest over the years and eventually return the original amount. Simple. But here's the interesting part. Who actually buys these bonds? Not just foreign countries. American pension funds, banks, insurance companies, mutual funds, investment firms, retirement accounts, even the Federal Reserve itself. In other words, millions of ordinary Americans indirectly own little pieces of the national debt without ever realizing it. If you've ever invested for retirement, or if your employer pays into a pension fund, there's a good chance you already own government bonds, which creates a strange and beautiful loop. Taxpayers pay interest on the national debt, and much of that interest flows right back into the retirement savings of ordinary people. The money isn't simply leaving the country. It's circulating over and over inside the very same financial system. But what about China? For years, headlines have screamed that America is owned by Beijing. Technically, there's some truth in it. China does hold hundreds of billions of dollars worth of U.S. Treasury bonds. That's an enormous amount of money. But compared to America's total debt, it's a surprisingly small piece of the puzzle. In fact, for many years, Japan has held even more U.S. government debt than China. The United Kingdom, Belgium, Luxembourg, and several others hold significant amounts too. So why do they all keep buying America's debt? Here's the twist. They're not really buying debt at all. They're buying safety. To the world's biggest investors, U.S. Treasury bonds are considered one of the safest financial assets ever created. Imagine being responsible for the retirement savings of millions of people. Would you gamble everything on risky bets? Of course not. You'd want something stable, something predictable, something you're confident will still exist in 10 or 20 years. That's exactly why governments can keep borrowing decade after decade. Because investors believe those promises are worth something. And in finance, belief is everything. Now, here's where things get even more interesting. Countries don't just borrow money. They also lend it. Japan lends to America. America invests overseas. European nations finance development projects across the globe. Developing countries park their reserves in the bonds of advanced economies. Money is flowing in every direction at once. It's less like a straight line, and more like a giant circle. Picture a poker table. But instead of bringing their own chips, every player borrowed their chips from the person sitting next to them. Nobody at the table truly owns all the chips. And yet somehow, the game keeps going. That is shockingly close to how the global financial system actually works. Every government owns someone else's promises. Every investor depends on someone else's debts. Every balance sheet is chained to another balance sheet somewhere across the planet. And behind every government bond stands an enormous network of institutions. Pension funds guarding the savings of millions of workers. Insurance companies protecting families and businesses. Investment firms moving trillions across global markets. Hedge funds hunting for higher returns. And sovereign wealth funds investing the fortunes of entire nations. Together, these institutions control tens of trillions of dollars. And whether most people realize it or not, their decisions quietly shape the lives of billions. If these institutions believe a country is financially healthy, that country borrows cheaply and life goes on. But when confidence begins to crack, everything changes. Borrowing becomes painfully expensive. Currencies lose value. Governments are forced to slash spending. Businesses freeze their investments. And ordinary families feel it through rising prices, disappearing jobs, and shrinking savings. A collapse in confidence spreads through the financial system faster than almost anything else on Earth, which is exactly why one institution sits at the very center of it all. An institution with the power to move interest rates, calm entire markets, and in some cases, create brand new money. The central bank. And once you understand what central banks really do, you'll see why many economists say something that sounds almost impossible. In the modern economy, money itself is born from debt. Think about it. Where does money actually come from? Most people picture giant government printing presses rolling out stacks of fresh cash. But in reality, that's only a tiny sliver of the story. Today's economy runs mostly on digital money. And astonishingly, much of that money only exists because somebody, somewhere, borrowed it. Let's make it real. Imagine you walk into a bank and apply for a $300,000 mortgage. Most people picture the bank opening a giant vault and counting out stacks of cash. That's not what happens. Instead, the bank simply creates a new deposit in your account. A few keystrokes, and new money enters the economy. You buy the house. The seller gets paid. The construction company gets paid. Workers earn wages. Suppliers receive new orders. One single loan ripples outward, creating economic activity far beyond the original transaction. Now, banks can't do this without limits. They're heavily regulated, and they must meet strict requirements. But the core truth remains. Bank lending expands the money supply. Debt doesn't just move money around. It helps create money that never existed before. The same logic climbs all the way to the top. When governments issue bonds, investors buy them. Later, central banks may buy some of those bonds on the open market. And how do they pay for them? Not by collecting taxes, not by selling gold. In many cases, they create new digital reserves for the banking system. The world saw this up close after the 2008 financial crisis. The Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan. All of them launched colossal bond buying programs to stabilize collapsing markets. The goal wasn't to make governments rich. It was to keep credit flowing, to keep banks lending, and to stop fear from freezing the entire global economy. Because the moment lending stops, everything stops. This is why economists describe our world as a credit-based economy. Growth needs investment, and investment usually needs borrowing. A company borrows to build a new factory. The factory creates jobs. Workers earn salaries. Consumers spend more. Businesses expand again. Used responsibly, debt is rocket fuel for productivity and living standards. Without borrowing, many of the roads you drive on, the airports you fly through, the hospitals that treat you, even the internet infrastructure carrying this very video, might never have been built. Debt isn't automatically a problem. In many ways, it's the engine that allows the modern world to exist. But here's the part almost nobody tells you. Governments usually have no intention of ever paying off all their debt. At first, that sounds outrageous. How can borrowing trillions without fully repaying it possibly make sense? The answer lies in something called rolling over debt. Imagine you take out a 5-year loan. 5 years later, instead of paying it all back from savings, you refinance it with a new loan on better terms. Homeowners do it all the time. Governments operate in a surprisingly similar way. When an old bond reaches its maturity date, the government issues a brand new bond. The money from the new bond repays the old one. Then the cycle begins again. This isn't a financial emergency. It's completely normal. In fact, it's how most developed countries have managed their debt for generations. Take Japan. Its national debt is now more than twice the size of its entire economy. If an ordinary person owed more than double their annual income, most banks would slam the door in their face. But countries are not households. Japan continues borrowing because investors still believe the Japanese government will honor its commitments. The United States follows a similar pattern. No serious economist expects America to wake up one morning and announce, "Good news, we've paid off every dollar." Because if that actually happened, the consequences could be enormous. Government bonds are used as collateral across global markets. Banks rely on them. Pension funds are built on them. Central banks steer entire economies with them. They're not just debt. They're one of the foundations of modern finance. Remove them, and the whole structure begins to wobble. That's why governments don't aim for zero debt. They aim for sustainable debt. Debt that investors keep trusting. Debt that can be refinanced smoothly. Debt that keeps the financial system running without triggering panic. Because in the end, the most valuable asset in the global economy isn't money. It isn't gold. It isn't even government bonds. It's confidence. And history shows us, in brutal detail, exactly what happens when confidence runs out. Greece, 2010. The country had piled up so much debt that investors began whispering a dangerous question. Can they actually pay this back? That single doubt changed everything. Interest rates on Greek debt exploded. Borrowing became impossibly expensive. The government could barely function and eventually needed emergency rescues from the European Union and the International Monetary Fund. But that rescue came at a brutal price. Taxes rose. Government spending was slashed. Wages and pensions were cut. Unemployment soared. For millions of people, this wasn't an abstract economic story. Businesses closed their doors. Young people fled the country in search of work. Families watched their savings disappear, all because confidence vanished. And Greece is not alone. Argentina has defaulted on its debt multiple times. Each crisis looked different, but the disease underneath was always the same. Once investors stopped trusting the government's ability to repay, everything became more expensive. Inflation accelerated. The currency weakened. People raced to convert their savings into foreign money before their purchasing power melted away. More recently, Sri Lanka ran out of the foreign currency it needed to pay for imports and service its debt. Fuel lines stretched for miles. Electricity became unreliable. Protests filled the streets. Different countries. Different governments. Different decades. Yet the same lesson over and over again. Debt itself doesn't destroy economies. A collapse in confidence does. So let's return to the question we asked at the very beginning. If every country owes money, who does the world actually owe? After tracing the flow of money through governments, banks, pension funds, investment firms, central banks, and international markets, the answer isn't China. It isn't Wall Street. It isn't the IMF. And it isn't a secret group of elites controlling everything from the shadows. The truth is both simpler and far more fascinating. The world mostly owes itself. Governments issue debt. Banks buy that debt. Pension funds own it. Insurance companies invest in it. Central banks hold it. Countries lend to one another, then borrow from each other again. It's a planet-sized web of promises. And every promise is supported by another promise. But that doesn't mean everyone benefits equally. Far from it. Here's the part that usually gets overlooked. Interest payments don't flow evenly across society. Governments collect taxes from millions of citizens. But the interest gets paid to whoever owns the bonds. That might be a pension fund, an insurance company, a bank, an investment firm, or a wealthy individual with a large portfolio. In other words, debt doesn't just move money between countries. It also quietly transfers wealth between groups inside society. People who own financial assets collect a growing share of those payments. People who don't own assets usually collect nothing. That's one reason economists often link rising debt with rising inequality. Not because debt is inherently bad, but because ownership of financial assets is deeply uneven. So, is debt a good thing or a bad thing? The honest answer is neither. Debt built the highways, the airports, the universities, the hospitals, scientific research, space exploration, even the internet. Without borrowing, much of modern civilization simply would not exist. But like any powerful tool, it only works when it's handled with care. Borrow too little, and growth starves. Borrow too much, and confidence begins to crack. Finding that balance is one of the greatest challenges every government on Earth faces. At the end of the day, money isn't just paper or numbers on a screen. It's trust. Debt isn't just an obligation. It's a promise about the future. And the global economy functions because billions of people wake up every morning still believing those promises have value. The day that belief disappears, the system changes with it. Because the greatest asset in modern finance has never been gold. It has never been oil. It has never even been the US dollar. It's confidence. And confidence is the one thing no central bank can print forever. If this video gave you a new perspective on money, hit subscribe. Because there's a lot more where this came from. Deep dives into the hidden history of money, power, and the global economy. The biggest stories aren't always in the headlines. They're hidden beneath the numbers. Thanks for watching, and I'll see you in the next one.